Welcome to Wholesale Change, the webcast and podcast from Distribution Strategy Group, where we provide thought leadership for wholesale change agents like you. Because if you're on this broadcast, you probably are a wholesale change agent. My name's Ian Heller. I'll be your co-host today, along with my business partner, my good friend, the prophet of profits and the doctor of distribution, Jonathan Bine, PhD. Hello, Jonathan. How are you today?
Flattered and honored as usual to be working with you, Ian Heller.
It's my pleasure. It's my pleasure. So we have a great show today, but we have been like rushing pell-mell to get this one put together, huh?
Well, if these guys would get their earnings results in earlier, we'd be just fine.
Yeah, we scheduled the show a week later. But so Granger announced this morning, and we're going to talk about them briefly. And so we were literally on their earnings call that started an hour ago. and listening to some of the commentary before we had to rush off and finish those slides. Amazon announced yesterday, and of course they had huge news that we'll get into in a minute. So it's been a crazy couple of days in earnings announcements. I mean, Amazon by itself, it just has so much you can barely absorb it all. So let's jump into it. But a couple of things before we start. One is that we're delighted to report that Wholesale Change is brought to you by Epicor. For nearly 50 years, Epicor has helped distributors stay ahead with flexible, powerful solutions designed to increase sales, streamline operations, and improve customer experience. Epicor's industry-leading ERP solutions are built specifically to meet the unique needs of wholesalers. With everything you need to grow your sales, profits, and productivity while distancing yourself from the competition, Epicor is focused on the things that matter to you. Work queues, PO variance queues, kitting, assembly and production orders, advanced inventory forecasting, VMI, and special project pricing. They build their software using industry best practices and 50 years of distribution experience, almost as much as I have. But Epicor's solutions are far more than just tools for pick, pack, and ship. Fully cloud-based with modern UI, Epicor offers complete, robust e-commerce solutions, powerful BI and analytical tools, modern API and EDI, value-added services, WMS, virtual assistant, and much more. You can learn more about how Epicor helps thousands of wholesalers succeed by visiting epicor.com. And also, since we threw these numbers together so quickly, we just want to share a brief disclaimer. So if you're on a podcast, listen closely. The information shared on the Wholesale Change Show is not intended to be a source of advice or financial analysis with respect to the material presented, and the information contained in this website do not constitute investment advice. So, and that's another way of saying, boy, we sure threw this stuff together. So we think it's right, but double check. All right, so the first company that we're going to talk about, and there aren't a lot of words on this page, but boy, the numbers and words are remarkable. Why don't you walk us through their sales?
So their fourth quarter numbers were 125 billion. That's billion. That was represented a 43+% growth over fourth quarter 2019. Total number for the year came in at 386 billion. Operating margins were down slightly. Gross margins were also down slightly. Then in the earnings call, they talked about some of the pressure from the pandemic in bringing down some of the margins. Their market cap is at a really frothy, just under 1.7 trillion as of yesterday.
Is that right? That's incredible. Remember when we talked about, gosh, you will be the first company to $1 trillion, and you're telling me that they're at 1.7 trillion now.
1.7. Yeah. I mean, actually, if I look at the next, so if I look starting at distributors in our sector, sort of pure play distributors, the highest valuation is 38 billion. So they could go buy a whole gaggle of distributors with their market cap if they wanted to. And that market cap is an 82% increase over fourth quarter 2019.
Yeah, I think their full year sales were up like 36 or 38% or something, right?
Yes.
So they grew from 282 billion to 300 and what'd you say, 86 billion in 1 year?
86 billion, yes.
In 1 year. So so we talked about this yesterday when we were preparing for the call, Jonathan. But I think we agree, unless you go back 100 years to Standard Oil or somebody and restate their growth in modern dollars, you probably could not find a company that grew, 36% off a $280 billion sale. I mean, there have only been a few companies that size anyway, ever. But I mean, That would be impressive growth if you were a $50 million company and then did it off of 280 something billion dollars. It's
Absolutely
unbelievable.
staggering. Yeah, it's really hard to imagine any other company in any other sector today that could have that kind of growth.
Right. Right.
So
Now, in the middle of all this, the big announcement yesterday, despite the unbelievable financial performance, and we're going to get to a couple more aspects of that in a minute, but the big news yesterday was that Jeff Bezos, some article said he stepped down. I prefer to say he stepped up from CEO to executive chairman. Um, and they named the head of AWS as his successor, Andy Jerry. Is that his name? Jerris. Um, so sorry for not knowing that, but so Bezos is stepping out of the CEO role. Now, what do you think of this? I mean, I was surprised. I assume you were too.
yeah, I was surprised at just that it happened. But if we look at all of the other big tech companies, they've had a similar evolution, right? Gates stepped out of Microsoft. The guys stepped out of Google. There was a successor to Steve Jobs at Apple. So in many ways, it's a natural progression for a company at the stage of growth and maturity.
Yeah, what's interesting is that every now and then you get a CEO who can start a business in their garage and then grow it to be this gigantic public company. But most of the time, entrepreneurs at some point in time kind of run out of their management expertise and they hire a sort of big company CEO to come in and run the company for them. Nothing
Right.
wrong with that. But Bezos is one of those rare people like Michael Dell or Bill Gates who was able to start the business in a garage and make it, in this case, the most valuable company on the history of the planet, I believe, and still run it.
Yeah.
And that's an amazing skill set. So his skill set must have grown as the company's
Yeah.
portfolio of work.
Yeah, I mean, the way venture folks look at it at a CEO is exactly as you described. This is somebody who is an entrepreneurial who can get us into market, and and then there's another category of somebody who can scale the business. And what you're saying is that he's done both brilliantly, and he scaled it beyond anything anybody could imagine.
Yeah, and I read his comments about what he was going to do now, and he says, I'm not stepping away. I want to focus more on Blue Origin, the rocket company, and the Washington Post, and some other things that are near and dear to his heart. So he can spend some more time on those things, which will probably make all those things succeed in a bigger way because there's nobody like Bezos. As critical as we are of Amazon business, sometimes there is nobody like Bezos.
Right.
And he also said he'll still be there for one-way door decisions. He'll be participating in those. And so if you haven't read the Amazon leadership principles, you're missing out. You should read them. And one of them is that, I think this is in their principles, but if not, it's something that they talk about a lot, where there are two kinds of decisions, one-way doors and two-way doors. And the one-way door decisions are, hey, you make a commitment to this decision and it's going to change the company in a big way. It's really hard to get out of. You can't just back away from it. And then there are two-way door decisions. And so Amazon views one-way door decisions as things like acquisitions. You go and buy a company. That's the example he uses in his quote. If you're going to make an acquisition, then that's a one-way door decision because you can't go back once the deal is done. Or at least it's really expensive and hard to get out of it. But a lot of two-way door decisions, like launching new products or whatever, new services, those are two-way door decisions, and it should be easier to make those decisions. And I would say, when I read that in Amazon's leadership principles, I would say that generally speaking, I haven't been in a company that has tried to classify decisions in those ways. They've applied the same criteria to both. And I think that's an important distinction that they're making at Amazon. Now, they also had their earnings release, their 10K. And so, one of the problems with Amazon, if you compete with them in the distributor space, is they don't disclose the results of Amazon business, right? So the speculation around their results, depending on whether you talk to Applico or Royal Bank of Canada or Merrill Lynch, et cetera, is, they're on a track to be $32 billion or 50 something billion or 70 something billion in gross merchandise value by 2023. That's a huge difference, right? So nobody knows how big Amazon business is, and they're not required to disclose it because, this is, the SEC's rules aren't really made to account for companies of enormous scale. Like, so for example, there's an SEC disclosure rule that says that once a business unit equals 10% of revenues, income, or assets, roughly, then you have to disclose the performance of it, right? So that's probably an oversimplification, but that's roughly the rule. So,
So by that metric, then, if we go by revenue, then we
right,
know Amazon is no larger than 38 billion. If that
correct.
were the metric, right?
If that's the metric, then they would have had to disclose it by now if it was 38 billion.
Right.
But they're growing so fast. So you think about Grainger is roughly a $12 billion company, right? So if they had a $2 billion subsidiary, they would have to disclose it,
Mm-hmm.
or even $1.5 billion. But Amazon Business could potentially be 20 times that size and not trigger the disclosure requirement because Amazon is so massive. Now, I don't think Amazon's doing anything unethical. Why would they disclose competitive information if they don't have to?
Mm-hmm.
Right. But it is sort of structurally unfair, even though I'm not accusing Amazon of doing anything wrong. But who knows how big they are? Nobody knows. So I went through their 10K and I searched for the words Amazon Business. It doesn't appear anywhere in their 10K. They don't mention it at all, which frankly is more scary than if they did mention it.
Yeah.
They mentioned the word distributors once or twice in sort of a long list of competitors. But boy, you go through that 10K, they don't talk about B2B, which, either means it's not that important to them or they just want to keep it under the radar. I think it's probably the latter. What do you think?
Yeah, I think that's right. Well, and if we look at where they're going, so you look at that $125 billion in fourth quarter, you say, well, at that run rate, and there are some caveats, at that run rate, they're at a $500 billion business. But the caveats are A, pandemic, B, fourth quarter is going to be good for retail anyhow. So I think be curious what kind of guidance, and they haven't given guidance on growth for 2021. You'd be curious if they end up as a $500 billion business this year, if they actually overtake Walmart in revenue.
I don't know. I mean, like you said, fourth quarter is always the biggest quarter for them because of the Christmas rush for their holiday season. And, they had some pandemic related growth this year. My guess is they'll overtake Walmart in 2022 rather than 2021. But certainly they're on the way, right?
Yes.
At this kind of growth number, they're going to blow everybody away. And I think it's going to trigger discussions around antitrust at some point in time, although I don't think that's going to really help.
There was another interesting piece in the earnings call and in the report about both Amazon Fresh and Amazon Go. Amazon Go is their retail offering that kind of competes with a mashup of 7-Eleven and the Whole Foods, counter where you get food. You can go into an Amazon Go store and you don't even make a payment. It just scans your card. You walk in, it figures out everything that you've got in your shopping cart. If you decide to put something back on the shelf, it figures that out as well. These stores are about 3,000 square feet. There's no checkout people, so their cost to serve is lower. They are now finally at about 25 stores. They had expected a much larger rollout, but it's a very interesting play from the standpoint of, first of all, it's brick and mortar. That's not what we know traditionally about Amazon. Second of all, the use of technology in gaining efficiencies in these stores.
Do you see them doing something like that in B2B potentially?
That's interesting. I don't have a deep thought on that one right now, Ian.
Yeah, it doesn't seem to fit to me, I guess. Now, we'll see. I mean, I think it is interesting, and they're going to revolutionize a lot of that retail technology. And a lot of times they move technology from one industry they're into to another. Now, marketplacepulse.com sent out an email this morning, and by their estimates, Amazon did $490 billion in gross merchandise revenue now in the year. Now, the third-party revenue, the Amazon Marketplace, that 300 billion, Amazon only reports those service revenues. They don't report the gross merchandise revenue. So here's how this works. If you have, Joe's Industrial Supply, and Joe's Industrial Supply sells on the Amazon Marketplace, and they sell a product for $100, and Amazon has fees in place to get 15% of that, they would report $15 as their revenue, and the rest they don't. That is just what's called gross merchandise, or the whole sale is called gross merchandise volume, and so However, Amazon retail, that's where they are the merchant and they buy and sell. So they're buying, putting in their distribution center, and then selling direct to the customer, right? And so that is full revenue. So that's a full sale, just like anybody else would count revenue. The Amazon Marketplace revenue is just the commission that Amazon makes on the sale, right? But the $300 billion is the whole gross merchandise value, all right? And last year, and I think it was for the first time in Jeff Bezos' letter to shareholders, he reported that 58% of total gross merchandise revenue was coming from third parties. And Marketplace Pulse is now saying that it's 62%. So nearly 2/3 of Amazon's sales isn't coming from them as a merchant. It's coming from them representing sellers selling through their platform, which is really extraordinary because it was zero in 2000, roughly. And Walmart didn't get into this business, I think, until 2009. So this third party revenue is a growing part of Amazon's mix. And we think it's important for distributors to understand sort of how that works and what it means for them. So we put together a slide that explains sort of how the financial model works in a third-party marketplace, not just Amazon, but any third-party marketplace. So on the left is a traditional distributor, right? So traditional distributor, and by the way, if you're on the podcast, I've got two models up. On the left is the distributor's model. On the right is the third-party marketplace model. I'll talk about the distributor model first. The distributor has really two components to their costs. They have fixed costs, and that's the stuff you buy that's long-term, and it doesn't vary with your sales volume. And then there are your variable costs. So these are your working capital, your inventory, among other things, your picking and packing and ship costs, and any value-added services that you add. It's your transaction processing cost to answer the phone, et cetera. And so those costs vary. That's why they're called variable costs with sales volume, right? So as your volume grows, your costs grow, which means that even though you are leveraging and becoming more profitable over time because your fixed costs aren't growing, your variable costs are eating up a lot of the difference. So you do become gradually more profitable in a distributor or retailer's model, but your variable costs are going up with your sales. So that gap is not growing particularly fast. So you're going to be more, in a normal business, you're going to be more profitable on a percentage basis at 70 million than 50 million, right? But it's not linear because you have a lot of variable costs that are going up with your sales. Okay. On the right-hand side, I've got what I call a third-party marketplace model, right? What that shows is that Amazon, when third-party sellers are selling on Amazon really has no variable costs. Okay, so they've got this huge platform, they've got this website, they've got this demand generation system. Every distributor who's on our call right now, right? And we got a bunch of them. Every distributor who's on our call right now could add their products to Amazon and sell through Amazon tomorrow, and Amazon's costs would really not go up at all. There might be a one-time charge or one-time expense for them to load all those products into the system. But after that, every sale costs them nothing because they're generating the demand online, but that doesn't cost them any extra. People are coming to them and searching for products. And then when they get the order, they're sending it off to the distributor, and the distributor is doing the picking and packing and shipping and pulling the stock out of their working capital and running their forklift and their labor and their transaction processing system. And so the distributor is bearing all the variable costs. And so the distributor's profitability is the same servicing Amazon. Well, it's the same model as if they're generating the demand themselves, right? They may save a little bit on marketing costs, but overall, the distributor has got variable costs and the transaction, Amazon has none. And I think that's one of the reasons they love this notion of third-party sellers, because it allows them to scale off a pure fixed cost base and become more profitable over time. Now, there are a couple implications here. One is that Amazon's going to get more competitive over time because their costs are going to shrink as a percentage of their sales, giving them more pricing flexibility. But there's also a bigger threat here, Jonathan. You want to guess what that is?
If they start working with manufacturers directly.
Right.
Yeah.
Why include the distributors? Because manufacturers can do a lot of that activity themselves, and distributors have taught them how, right? Because distributors have asked manufacturers to do fulfillment for them. So most manufacturers can fulfill small orders now. And so the ultimate end game here for Amazon, we believe, is that the manufacturer takes on the picking and packing and shipping of the order out of their working capital inventory. Amazon provides the demand generation and the transaction processing and the customer service, so to speak. So they're really splitting the distributors' value added services between the two of them for simple transactions, and they're also splitting the margin. And the distributor is out of the loop entirely, and actually the distribution functions are split between Amazon and the manufacturer.
Well, and actually in the operating income from Amazon over the last 4 years, we can start to see the shift between, a point or two of operating income to now for the year, close to 6%, 5.9%. So they're starting to shift significantly towards profitability. That's a significant increase over a 4-year period in profitability.
Yeah, and we just finished up a 7-part series for NAW, the National Association of Wholesaler Distributors. You should go to naw.org/tech will transform. And in that series, we looked at 40 manufacturers who normally sell through distributors. And we just checked to see if they're selling through distributors on Amazon and Amazon Business, or if they're selling through them directly. And 30 out of 40 are already selling directly on Amazon. So this model on the right is really Amazon/Amazon Business, and the manufacturer with the distributor left out in the cold for those sales.
Yep. So we have a good comment here from one of our listeners. Alex says, we see a lot of MRO industrial manufacturing distributors lagging when creating their own web shop/e-com platform or selling via marketplace. By the way, Alex is from a leading OEM, leading manufacturer. What do you think is holding them back in light of all the evidence of consumers changing ways of purchasing behavior?
You want to go first?
You go ahead.
So look, I mean, I think if 2020 revealed anything, it was that if you didn't have great digital skills, you got punished, right? And if you had great digital skills, you picked up share. And so I think that distributors lagged because they could get away with it, and they paid the price in 2020, those that didn't have good digital skills. So I think it was a lack of understanding. I think it was Salesforce conflict. They would build these web platforms and then not allow certain SKUs on there, or say call for price or other things that just absolutely killed their websites, right? I think in terms of they have to get past that. You have to find a solution to represent your whole value proposition online. It's not optional. This is what CEOs are for, is to provide leadership to solve these kinds of problems. It's time for CEOs to step up and lead in digital, not allow it to be a sideline, but make it a core part of the business, because the world is just there now. I think in terms of selling through marketplaces, I don't really see the upside in selling through Amazon or Amazon Business. I mean, I think they're just going to learn from your data, and you're going to give them if they choose to, and organizations like the Wall Street Journal are accusing them of already doing this, they're going to use that data to displace your SKUs with their own. And there's the risk that they'll just go to your suppliers directly. I mean, this whole FBA, fulfillment by Amazon, what value is the distributor adding? You're shipping your inventory to an Amazon warehouse. They're doing the picking and the packing and the shipping. It would be better for Amazon just to buy that directly from the manufacturer, have the manufacturer to do the fulfillment directly, right? And so, go ahead.
Yeah, so I think an interesting point that you bring up here, Ian, is the simple transactions versus the more complex transactions.
Right.
I think a lot of distributors are stuck in the, hey, we can't do more complex transactions online. That's not how our customers buy. But what they're missing is, if you look at things like tools, right? Tools are great to sell online. Those are simple transactions. And so because they're getting focused on the complex transactions, they're perhaps discounting the value of the role that digital can play.
Yeah, and by the way, there are marketplaces that are safer, right? Like Google's got a marketplace that right now, at least the last time I looked up, is charging 0 commissions. For strategic reasons, Google feels like they've got to have a marketplace because Amazon is threatening their search traffic. Different story. And so there are a lot of distributors selling on Google. Google doesn't isn't a merchant. They don't have product managers and distribution centers and delivery fleets. And so I think they're pretty safe marketplace to sell through. Unfortunately, they're a tiny, tiny fraction the size of Amazon. I just think Amazon in the short run is good for distributors. In the long run is a big threat. And so I would be careful. By the way, if you do have questions, please add them to the pile. Alex, thanks for yours. We try to answer them as we go. Anything else you want to talk about Amazon, or shall we move on, Jonathan?
Let's move on.
Oh, wait, we got to talk about Bezos, the implications of him leaving.
Oh, you go.
So I gave the opinion, I don't think it's going to change a thing, that they're so strong and that they're not a culture or a personality driven organization. He's built a management structure that's going to carry on and it's going to be seamless. What do you think?
I think so. I think the engine is built and it's running beautifully. And the person that he's bringing in has been with the company from the 90s, so has seen growth the entire way. And I'm confident that he's chosen somebody who's internalized that well and is ready to take the company to the next level.
Yeah, that's how I feel. I also think, by the way, in this marketplace discussion, distributors need their own trusted industry-wide marketplace because the simple transactions are going there. You can't trust the merchant-centered marketplaces and nobody else has any volume. So that's my view. Okay, next, let's talk about Grainger. So we were feverishly taking notes this morning and looking at their earnings release this morning. You want to go through some of these results, Jonathan?
You bet. So they've managed through things, I think, pretty well. Fourth quarter sales were up slightly over fourth quarter 2019. Gross margins they saw some headwinds from the pandemic, both customer mix as well as product mix. So if you look at, gloves and sanitation stuff and safety, those are lower margins certainly today than they were 10 years ago. So they saw some headwinds on the gross margins. They manage their SG&A very well. And as a result, they brought in a healthy operating margin of 11% for the fourth quarter, 10% for the entire year. And they actually grew the business. So they're up to just under 12 billion in the face of these enormous headwinds of the pandemic.
Yeah, one thing I would point out is that their gross margins for the full year were just under 36%, 35.9%, right? And some of that was pandemic related, but they were already coming down. I mean, that's like 900 basis points in year over year, or from, I don't know, 7 or 8 years ago, what their margins were. And, still down. I think they were over 45% at one point during some quarters in their history. So they've had this huge decline in gross margins.
Intentionally, by the way.
Which I think is really smart. I mean, they were overpriced for the market, and then in an environment of increasing competition. And many analysts, they point to gross margin as it's got to go up all the time at sacrosanct, but that's not realistic. And pursuing that path gets you to the point where you're overpriced, and that's where they were. And so some of that margin cutting, which has to be paired with cost cutting, happened before DG McPherson got promoted to CEO, which I think was end of 2017, October 2017, something like that. But a lot of it he drove, right? I mean, he had that in his honeymoon period. You could get away with, like anyone, with more things than you can after you've been there for a while. This is my interpretation. It's nothing he said. But so within his first year, he said, look, we need to cut gross margins. And I think that was essential, but they've also cut expenses. So I think they're down to a much more realistic level of gross margin that is sustainable. So let me postulate this. If you view DG McPherson, I don't know him, I've never talked to him, I just heard him speak a few times, but if you look at his tenure there, I think he's kind of finishing Act One, right? And Act One was reshape the business, get the cost structure down, get the margins into something more realistic. Don't bury the company while you do that, because if you mess up either of those, that's exactly what happens, right? And I think he's, they're growing but I think the next challenge for him is for him to figure out how to grow the company more rapidly. which is not a criticism of his past performance, but is a challenge for the future. Because I mean, one of these days we're going to see Amazon businesses numbers. And I know Grainger feels like they've got some pretty good barriers and they go after different business than the Amazon business does, but certainly there's some crossover. And
Well, and in a sense, they're reducing one of the key barriers, which is they're rapidly closing branches.
well, it's only a barrier if they add value in ways that are important to customers,
Point
right?
taken. Yeah.
And so I remember, I talked to a CEO of an HVAC chain one time who told me that Grainger walking away from the contractor market, which is an overstatement, but putting less emphasis on it was the best thing that ever happened to his company, right? Because all that over the counter business, replacing motors and controls and stuff, that was really important to an HVAC chain. And Grainger used to be in that business and they kind of de-emphasized it to put more emphasis online. That was a long time ago. It's probably 10, 15 years ago. But I think the branches in that role are a barrier because that technician with the dead motor needs it right now and he needs help matching it up. And at least for now, that's a pretty good barrier. If you don't offer that kind of expertise at the counter, or you don't do value-added services like kitting or labeling or bin replenishment or whatever out of those local branches, then they're not differentiating. They're just expensive brick and mortar. Because you look at Fastenal a lot, Jonathan, right? And they've kind of they've kind of transformed their branches too, as I understand it.
Yeah, they're making a shift to really two types of branches: a traditional branch where you walk in that's full service, but then really it's a second type of branch that doesn't have they call it backdoor branches. There's not really a showroom. You don't walk in the front, and they're transforming it so that you go pick up an e-commerce order, almost like a will call. And maybe it's even more like a DC, but the point is it's not a full service branch. And they're finding that to be much more efficient for their growth in e-commerce, which, by the way, finally hit above 10%. They announced that as a milestone.
Hmm. Yeah, and Grainger divested Fabry and Grainger China last year, which I think was important. I think they still own Cromwell in the UK, which is sort of the UK version of Grainger, big MRO distributor. And they believe that in 2020, they outgrew the MRO market by 800 basis points, which is pretty significant. They're not offering guidance for 2021 yet. I was taking notes during the call, and I think they said that in January, they grew 9% over prior year. Did you hear that?
I did hear that.
I think that was the number, but they're still expecting the first quarter to come in at 3 to 5%. So this is as always, a well-operated company. They generate a ton of cash, right? They generated $1.1 billion in operating cash flow. They've got good, healthy margins, right? They've navigated through this pandemic, I think, very well. The challenge is, can they find a way to grow even faster? Because they had a brief mention of Zorro, which that they've added 2.5 million SKUs. They've got over 6 million. Zorro does have a third-party marketplace. My impression is that they need to move faster with it than I see them moving. Do you have an impression on that?
Absolutely the same.
Yeah. So
Yep.
you just don't hear much about it. I mean, I just don't. I know they're trying to add third-party sellers, but it doesn't. I'm not sure why they aren't going faster. Maybe they're just not ready. But I would like to see. If Grainger wants to compete with Amazon Business, I think Zorro has to move faster with their third-party marketplace. Maybe they don't want to do that. I guess we'll see. Moving on. Applied Industrial Technologies.
Yeah.
So go ahead.
So the numbers quarter over quarter, fourth quarter of 2020 versus 2019, they were down just under 10%. Operating margins came down just a tiny bit. Gross margins came down from 28.9% to 27.9%. So in terms of their share price, a lot of companies took a hit sort of mid-year due to the pandemic. So they've grown share price 31.8% in 6 months. But over the last year, they've grown 23.6%. So that's a very happy story there.
Yeah, I mean, I think they've had upside surprises, so good surprises versus analyst consensus predictions 5 quarters in a row, something like that.
Right.
So they're even though the business has declined somewhat, they're doing better than everyone thought they would have, but it's really coming from acquisitions. So according to they have a really great investor deck on their investor page. If you're interested in this company, They've done 43 acquisitions since the year 2000 and 26 since 2012, representing over $1 billion in sales. And their annual target is $100 million of sales from acquisitions annually, which would be about 30% of their growth goal annually.
Mhm.
And that's a ton of acquisitions, and they must be integrating them pretty well because they don't seem to be eroding much of their sales.
Well, for some companies, acquisitions is a core competency. And as we look towards some of the trends that we've been noticing with potential consolidation, the companies that can acquire well are going to be well served with that competency.
Yeah, actually, one of the analysts on their earnings call asked them, "What are you going to do with all that cash?" And I thought, I think that's obvious. They're going to go buy more companies because they've got like, I don't know, $290 million of cash or something on their balance sheet right now. But what was interesting, so just for fun, I went into the earnings call transcript and I opened their 10Q because this was second quarter for them because they have a off fiscal year, uh, off calendar year fiscal year. So they just finished their second quarter, and I just searched for the word online. I searched for the word web. I searched for the words e-commerce, e-commerce, e-procurement. None of those words were mentioned. I mean, there's one mention of web for like registering their financials with the SEC or something, but that was it. And so it was just interesting. You have this whole earnings transcript with analysts asking questions. Nobody mentioned e-commerce or e-procurement or online. Now they've got some online capabilities, but what I would infer from this is a company that had a big sales hit in 2020 because they didn't have good enough digital competencies. I mean, that's my conclusion. What do you think?
It could be. I mean, the sector as a whole is not strong on digital. If you look at the other leading players in the sector, it's just kind of representative of where they are. So,
And by the way, that's not even a criticism. No one saw COVID coming, right?
right.
So
Yeah.
it's not like, oh, you should have seen this coming. No, they couldn't have seen it coming. And but it does feel like it doesn't feel like as much of an emphasis as it should be. We have another question. Let's see. How do you see Internet of Things solutions from OEMs expanding in the distribution space? Will this force a new wave of upskilling, or will OEMs look to abandon traditional distributors in favor of those who understand SaaS solutions but don't necessarily understand the market/industry? That's a complicated question. Are you reading this, Jonathan?
Yeah, I am. So we have done some research on advanced technologies playing in the distribution space, between the distribution space and the end customers. IoT did not come out as strong for most of those respondents. I mean, there were a few folks for whom it was strong. What do you think?
I think we should get Alex on the phone and ask him more what he means. I think generally speaking, look, I mean, there are a couple of questions here about the bottom line is, are suppliers going to integrate forward and sell direct? And clearly that's happening. I mean, we see it in all of our data, right?
Mhm.
And they're participating in marketplaces directly. They're building their own marketplaces. They're selling directly and risking the channel conflict. And I don't think that's going to slow down anytime soon.
But here's where there's a role for the channel. To the extent that the IoT looks more like a managed service, that's probably something you want a channel member doing, either a distributor or perhaps a contractor between the distributor and the end customer, actually doing the monitoring and the management of the end customer's infrastructure. So if you think about electrical, there are, Schneider has come out with a lot of stuff related to IoT through their Square D division. And they have channel members who are providing IoT services to end customers. They also have channel members who are enabling contractors to provide those IoT services. So I think there's a multi-layered management of the IoT things in certain sectors where automation matters.
Yeah, I think that if I were a manufacturer, I would work on upskilling my traditional distributors more than relying on distributors who understand SaaS solutions but don't understand the market or the industry. Because I think if you don't understand the market or the industry, you can't understand the customer's needs well enough to make the right solutions work for them. Is the short answer to that question. So, I think, I mean, look, if you look at Applied, and they do much more complex transactions overall, right? They do a lot of stuff that they do is more configuration and engineering. And I mean, there's a place for companies like this. And I think, to be fair, that's another reason it's hard for them to do e-commerce, because they don't do as many of the simple transactions. I mean, a much larger share of Applied's business is in these more complex transactions. I think they also sell into the oil field or in the oil industry quite a bit, and that was down. So I don't know that really Applied did anything wrong last year. I think they might have some barriers that they can leverage, but it'd be an interesting company to talk to about strategy, because it's not a simple transaction business. They can't just put stuff on the online and sell it at the same rate that a Grainger can, right? Because they have more complex engineered solutions. And they're in some markets that are suffering a little bit. So, and they're outperforming analyst expectations. So, and they're generating a ton of cash and they're buying these companies. So it's a really interesting case study, because it looks like a really, really well-managed company that's managing a variety of thorny challenges simultaneously and still figuring out how to make a lot of money. So it's interesting. Want to add anything to that, Jonathan?
Nope.
Okay. The last company we're going to talk about today is Avnet. You want to run us through the numbers here, Jonathan?
You bet. So Avnet's second quarter sales, which ended December 31, 2020, were 4.7 billion. That's up a little bit from 2019. So they were able to grow. Operating margins were up 1.2%, and then the gross margins came down a little bit. The share price, this one also took a big dip in the middle of the pandemic. So you can see they're up 41% from 6 months ago, down a little bit year over year. The total market cap right now is about just under 3.9 billion. So this is an interesting business. If you look at the comment there, the risk of supplier-driven disintermediation, Avnet, at least the traditional Avnet business, makes their money doing production supply. And so this could be, they're playing into a bill of materials that's 100 or 200 or 300 lines long. And some of those lines might be a customer needs 1 million items at 2 cents an item, right? I mean, it's literally that kind of just micro transaction that you have with a lot of what they're doing. So I think in terms of the, where they sit with regard to supplier-driven disintermediation, there's real value there. I don't think most manufacturers want to be handling an order of 1 million items at 2 cents a component. I don't think that's a business they want to be in. And that's in contrast. So Ian, you were VP of marketing at Newark Electronics, which was part of Premier Farnell. Avnet bought Premier Farnell a couple of years ago. That's a different business, right? I mean, that's not a production supply business. Do you want to describe a little bit of that business?
Yeah, so there are a few companies like Newark and a lot of what DigiKey sells that goes into what design engineers use to make prototypes out of. So there are all these electronics companies in the US, and when they're done with all their designs, the final products are produced in China or wherever, or at least a lot of them are. But the prototypes are all made in the US, and there's a fairly substantial market. I mean, it's billions of dollars for electronic components to make prototypes and do design work with. And there's also a pretty healthy market for electronic MRO products, right? So people who are going out to repair, anything from stoplights to the conveyor belt at your grocery store, right? If they need electronic components to do the job, or machine tools or whatever, they're going to get it from a catalog supplier. So that's what we used to call it, like Newark or like DigiKey. And as a result, those margins and that business model looks much more Grainger-like than this. I mean, if you look at, this is a $17 billion company with less than a $4 billion market cap, right? Because their margins are so small. And I think Applied is over 3 billion in market cap. We just looked at them, so these are small margins. And the reason I put that risk of supplier driven disintermediation in there is because people have been talking about that with respect to Avnet and Arrow, which are the big two in production supply electronic components, for 20 years. And I actually don't think that risk has changed much. I think they still add a lot of value. And some of the analysts say, well, electronic components manufacturers are going to start supplying the factories directly, and newer technology makes that easier, perhaps. But I think there's still a lot of value add here. I think these companies are always challenged on how they can grow their margins and grow their enterprise value, which is why they probably, I would imagine, why they bought Farnell. But it's
and the margins in a Farnell are in the mid 20s to low 30s. Is that?
I can't remember. I thought they were in the 30s, but I don't
30s.
remember.
Yeah. So again, these are very, very different models that the production supply versus the sort of the designer prototype world. And so Avnet is looking to integrate some of the designer engineer focus at the higher margins into their business to serve both parts of the market.
Right. Now I have a question. This is from our friend Brick. More companies are offering inventory solutions. Grainger has engaged this philosophy. Do you feel distribution has to engage more on holding and managing inventory on their customer site? Well, I think it's an option. I think, if you want to survive the onslaught of the various disruptors who are coming into the industry, particularly the online disruptors, the closer you can get to your customer, the better. And so I think being on site with vending or, integrated supply or bin replenishment or whatever really helps you lock in that product business. So yeah, I mean, I think you see it a lot in the industrial segment. I think it's growing in some of the, on the carpet MRO, as we used to call it at Grainger a million years ago, commercial stuff, et cetera. So I would say, yeah, the answer is probably yes. You certainly should investigate that as part of your value proposition, because the more useful and essential you are to your customers, the more you play in their daily operations, including managing their on-site inventory, the better moats you have. What do you think, Jonathan?
I think that's exactly right. The general category of VMI is something that the marketplaces are less apt to do. Frankly, it would be a high lift for them to be able to provide those kind of value-added services. So this will definitely be moat strengthening rather than moat diminishing.
Good. Okay. Anything else before we wrap up, my friend?
I think we're good.
Okay, good. Well, you have been listening to the Wholesale Chain Show. Hope you enjoyed it. We'll be on again on Wednesday, February 17th at noon Eastern, 9 Pacific. If you would like to reach us, I'm Ian Heller, or iHeller at distributionstrategy.com. Jonathan is Jbein, Jbein at distributionstrategy.com. We'd love to hear from you. We'd love to get your questions. If you would like to talk to us, we can do so on background or off the record, as they like to say. We love to get intelligence and input from distribution executives on the challenges they're facing every day, so we can talk about them in a very general way on the Wholesale Chain Show. Jonathan, it's been a delight as always. Thank you everyone for your time, and we look forward to meeting you again online in about 2 weeks. Have a great time, or have a great day. Bye now.
Take care, everybody.